Breaking news out of Silicon Valley. NVIDIA just signed a deal, but here is the twist. They did not buy another AI chip giant. They just partnered with a tiny under-the-radar software company that Wall Street is still sleeping on. And if you are not paying attention, you might miss the next 10x move in the AI market. This is Wealth Lab. Today we are breaking down why this unknown stock just got the ultimate stamp of approval from Jensen Huang himself. We are going to look at the technology, the financials, the competition, and most importantly, whether this stock can actually deliver the kind of returns that early NVIDIA investors saw 15 years ago. Stick with me because at the end of this video, I'm going to tell you exactly how I find these hidden gems before they explode. I'm also going to share 3 specific catalysts that could send this stock much higher in the next 6 months. And if you want to catch the next breakout AI stock, hit that subscribe button right now and turn on the bell so you never miss a Wealth Lab pick. Let me be absolutely clear right up front. Nothing in this video is financial advice. I am not your financial advisor. This is for educational and entertainment purposes only. All investing involves risk, including the potential loss of principal. Do your own research or consult a qualified professional before buying any stock. The stocks I discuss may be highly volatile and are not suitable for all investors. Alright, let me start with the news because this is bigger than most people realize. NVIDIA just made a quiet but massive strategic move. They announced a formal partnership with a relatively unknown AI infrastructure company. The ticker is IOP and the company is iOptimize Corporation. And the deal is not just a simple reseller agreement. This small company will integrate its core software platform directly into NVIDIA's enterprise AI stack. That means every company using NVIDIA's AI enterprise software suite will now have access to this small company's technology as a native feature. To understand why this is a huge deal, you need to understand the problem that almost every company faces today. Buying NVIDIA chips is easy if you have the money. Actually making those chips work efficiently for your specific AI model is the hard part. Most companies end up using less than 40% of their GPU capacity because they do not have the right software to manage workloads, schedule tasks. iOptimize Corporation solves exactly that problem. Their software can increase GPU utilization by over 60% according to their own case studies. For a company spending $10 million a year on cloud computing, that translates into millions in direct savings. That is why NVIDIA wants them inside their ecosystem. It makes NVIDIA hardware more valuable, easier to use, and harder to leave. Now let me break down exactly what this company does, because this is where the 10x potential really lives. iOptimize builds what is called an AI orchestration and observability platform. In plain English, think of them as the operating system for AI infrastructure. When a company wants to run an AI model, they have to decide which chips to use, how many chips to use, how long to run the model, and what to do when something fails. Most companies do this manually or with custom-built scripts that break all the time. This company automates the entire process. Their software watches your AI workloads in real time, automatically shifts traffic to the cheapest available chips, restarts failed jobs without human intervention, and gives you a single dashboard to see everything. It is like cruise control for AI computing. The really clever part is that their platform is hardware agnostic. It works with NVIDIA, AMD, Intel, and even the custom chips being built by Amazon, Google, and Microsoft. This is important because the AI chip market is going to become much more competitive over the next few years. Right now, NVIDIA has over 80% market share. That will likely drop to 60 or even 50% as AMD and the hyperscalers roll out. Companies are going to want flexibility. They do not want to be locked into one vendor. iOptimize gives them that flexibility while still making it easy to use NVIDIA when it makes sense. That is why NVIDIA is smart to partner with them rather than fight them. It is the classic strategy of if you cannot beat them, make sure your product works best with them. Let me give you a specific example of how this creates a moat. Say a large bank wants to run an AI fraud detection model. They have NVIDIA chips in their own data center. They also have some AMD chips that they got at a discount, and they have credits on Amazon Cloud, which uses custom Trainium chips. Normally, that bank would need 3 different software tools to manage 3 different environments. Their engineers would spend weeks writing glue code to make everything work together. With AI Optimize, the bank just uploads their model once. The software figures out where to run it, how to split the work across different chips, and how to save money by routing certain tasks to cheaper options. The bank gets faster results at lower cost. That is real value, and that is why enterprise customers are willing to pay 6-figure annual contracts for this software. Now, let me get into the financials, because this is where the story gets really interesting. According to their most recent filings, AI Optimize generated $94 million in revenue over the last 12 months. That is up 42% year over year. More importantly, their gross margins are over 72%. That is typical for good software companies, and it means that every new dollar of revenue brings in 72 cents of gross profit. They have been profitable on an operating basis for the last 3 quarters. That is rare for a small AI company. Most of their competitors are burning cash and have no clear path to profitability. This company is actually generating positive free cash flow. That gives them options. They do not need to raise more money at a low valuation. They can grow organically and even start returning capital to shareholders down the road. Their customer concentration is also improving. Last year, their top 5 customers accounted for 40% of revenue. This year, that number has dropped to 25%. That means they are diversifying and reducing the risk that one customer leaving would crush the business. They now have over 300 enterprise customers, including names like FedEx, Siemens, and many more that they cannot disclose due to non-disclosure agreements. The balance sheet is clean. They have $120 million in cash and 0 debt. In a high-interest rate environment, being debt-free is a huge advantage. Their competitors who borrowed money at high rates are now seeing their interest expenses eat up all their profits. This company does not have that problem. Now, let me talk about valuation, because this is where most people get confused. The stock currently trades at $22 per share. The market cap is approximately $1.8 billion. For comparison, other AI software companies with similar growth rates trade at 8 to 10 times revenue. This company trades at just 5.1 times revenue. That is a significant discount. Why? Because Wall Street has not noticed them yet. There is very little analyst coverage. Only 3 analysts cover the stock. Compare that to a company like C3i, which has over 20 analysts and trades at a much higher multiple. When the big institutional money starts to notice this stock, and they will now that NVIDIA has put a spotlight on it, the multiple will expand. That is the double win. You get revenue growth and multiple expansion. That is how you get a 3-bagger or a 5-bagger, even without crazy operational outperformance. I want to show you what the chart looks like because technicals matter for timing your entry. Pulling up the daily chart here, you can see the stock has been range-bound between $18 and $24 for the last 8 months. Volume has been steadily declining during that range. That tells me that sellers are exhausted. There is no more supply coming into the market at these levels. The people who wanted to sell have already sold. Now we have a fundamental catalyst. The NVIDIA partnership, volume just spiked to 3 times the average. The price broke above the 50-day moving average. The Relative Strength Index, or RSI, is sitting at 62, which is strong but not overbought. That means there is room to run before hitting the 70 level that often signals a short-term. If the stock can close above that $24 resistance level on strong volume, the next resistance is all the way up at $32. That is a potential 33% move just from the breakout alone. And if the company delivers strong earnings next quarter, that resistance could turn into support, and we could see a sustained uptrend. But I am not just a chart guy. Fundamentals drive long-term returns. So let me give you 3 specific catalysts to watch over the next 6 months. Catalyst number 1 is the NVIDIA integration going live. The companies have said the integration will be complete by the end of the third quarter. When that happens, every single NVIDIA enterprise customer will see AI Optimize as a recommended solution. That is passive marketing at scale. It is like being the default search engine on every new phone. The customer acquisition cost for AI Optimize will drop to nearly zero while their competitors have to spend millions on sales and marketing. Catalyst number 2 is the next earnings report. The current quarter ends in 6 weeks. Management has already guided for 35% revenue growth. But here is the kicker. None of the analysts covering the stock have factored in the NVIDIA partnership yet, because it was announced after their models were updated. That means there is a high probability of a significant beat and raise. When that happens, the stock will reprice overnight. Catalyst number 3 is potential acquisition interest. This is speculative, but it is worth talking about. The major cloud providers like Amazon, Google, and Microsoft would love to own this technology. It would give them a competitive advantage in attracting AI workloads to their clouds. There have already been whispers that at least one hyperscaler has held exploratory talks. A buyout at a significant premium to the current share price is not out of the question. Even if an acquisition does not happen, the mere possibility creates a floor under the stock price. Now, let me be brutally honest about the risks, because I do not want you to think this is a sure thing. Risk number 1 is execution. This company is still small. Scaling from 300 customers to 3,000 customers is hard. Software bugs happen if they cannot deliver the integration smoothly, or if their platform has technical issues under heavy load. Customer trust will erode quickly. Risk number 2 is competition. There are at least 6 other startups building similar orchestration software. Some of them are backed by venture firms with unlimited capital. One competitor, called Runai, just raised $200 million at a $2 billion valuation. They are hiring aggressively and giving away their software for free to steal market share. This company will have to defend its turf while also growing. Risk number 3 is the macro environment. AI stocks have had an incredible run. Valuations are stretched across the sector. If the Federal Reserve raises interest rates again, or if the economy slows down significantly, investors will rotate out of high-growth tech stocks and into defensive sectors. This stock is not immune to that. It could drop 50% even if the company is executing perfectly. Risk number 4 is customer concentration, even though it is improving. If one of their top 3 customers decides to build their own internal solution instead of paying for this software, that would be a meaningful revenue hit. Big tech companies love to build internal tools. It is part of their culture. Risk number 5 is the NVIDIA partnership itself. Partnerships can end. If NVIDIA decides to acquire a different company or build their own orchestration layer internally, they could drop this partnership. That would be a massive negative signal to the market. Do not assume this deal is permanent. No deal is permanent in tech. So with all those risks, I think this is one of the most asymmetric opportunities in the AI software space today. The upside is substantial. The downside is limited by the strong balance sheet, existing profitability, and the NVIDIA endorsement. You are not going to zero here. The worst-case scenario is probably a 50% drawdown, which is painful, but not catastrophic if you size your position correctly. What is my price target in the next 12 months? If the company executes on the NVIDIA integration and delivers 35% revenue growth, I can see the stock trading at $44 per share. That is roughly a double from current levels. In 3 years, if they become the standard for AI workload management across all the major cloud providers, a 5 to 10 bagger is absolutely possible. But that requires everything to go right. No major product failures, no aggressive pricing from competitors, and no macro meltdown. Do not go all in on this tomorrow morning. That is not how Wealth Lab operates. We find asymmetric opportunities, where the potential reward justifies the risk. Then we size our position appropriately, usually between 2 and 5% of our total portfolio for speculative picks like this. We set a stop loss at 15% below our entry, and we let the position breathe. Watch the next two earnings reports very closely. The first report will show whether the NVIDIA partnership is already driving new customer inquiries. The second report will show whether those inquiries are converting into paid contracts. If both reports are strong, the stock will re-rate higher. If either report is weak, the stock will drift back to the support level, and you will have another chance to enter at a better price. Before I wrap up, I want to give you something extra. This is exactly the kind of stock I look for in my Wealth Lab watch list. Not the obvious names everyone is screaming about on social media. Not the meme stocks with no revenue and no product. The quiet compounders that are building real technology and partnering with the giants of the industry. I am currently tracking 3 other AI stocks that I believe could break out in the next 2 to 4 weeks. One of them just filed a patent for a new type of AI memory architecture that could reduce costs by 80%. Another one is rumored to be in acquisition talks with a major cloud provider. The third one just hired a former NVIDIA vice president to lead their engineering team. I am not going to name them here because I want to give my subscribers the full breakdown first. That breakdown is coming in my next video. If you want access to that watch list and you want to see the full deep dive on all 3 stocks, click the subscribe button right now, join the Wealth Lab community so you never miss these research reports again, and turn on the bell because YouTube does not notify everyone by default anymore. You have to click that bell. Now I want to hear from you. What is your price target for this stock? Do you think it can truly go 10x from here, or is the AI bubble about to pop? Are you buying this dip or waiting for a better entry? Drop your take in the comments below. I try to reply to as many as I can. If you have specific questions about the technology or the competition, ask me there. I read every comment. Thanks for watching Wealth Lab. Stay disciplined, stay curious. Do your own research, and I will see you in the next video.